Fast food built the most efficient growth machine in business history. More locations, more volume, more profit, the logic was airtight. Until the machine turned on itself. The industry overbuilt into a saturated map, trained customers to expect perpetual discounts, and raised prices 77% over 4 years. Those three decisions are now colliding at once. The most immediate damage is inside the franchise system. Franchisee margins are collapsing under the combined weight of rising wages, food costs, and royalty bills that arrive whether or not the store made money. $13.3 billion in operator value is at risk. Layered on top, the discount habit the industry created and now cannot break. Loyalty apps and value promotions trained diners to expect a deal every visit. That expectation is costing the sector $7 billion in suppressed revenue and pulling the price floor lower every quarter. The value menu, the original promise of fast food, no longer pays its own way. $8 billion in risk sits inside menu items priced below the cost of making them. Held there by competitive pressure, no single chain can unilaterally escape. Meanwhile, the workforce is shrinking. $6.7 billion in labor risk isn't just about wages. It's about an industry that can no longer reliably staff its own restaurants, forcing reduced hours and closed locations that generate no revenue at all. Input costs are compounding everything. Beef and coffee, two of the sector's core commodities, are repricing permanently, not cyclically. That $6.3 billion exposure doesn't reverse when the next harvest comes in. Here is where the threats stop being separate and start feeding each other. A franchisee squeezed by wages and commodity costs cannot absorb a delivery app skimming 15 to 30% of every third-party order. That skim is draining nearly $9 billion annually before the operator sees a single dollar. The building threats extend the damage forward in time. America has effectively run out of corners. The oversaturation problem means new locations cannibalize existing ones. And fast food is running out of pricing power entirely, with $7.3 billion at risk from a consumer who has already walked away once. The automation promise, the $60,000 machine buyout, is not arriving as rescue. It is arriving as a new capital burden on the same franchisees who are already underwater, adding debt to an operator class that has no cushion left. The players most exposed are independent franchise operators running 3 to 15 locations. No corporate balance sheet behind them, no hedging on commodities, no leverage in royalty negotiations. When their unit economics break, they do not restructure. They close. The brands themselves look healthy at the top line, and that is precisely the risk. Top-line revenue disguises operator distress right up until the franchise system fractures. When it does, the brand's royalty stream fractures with it. This is what a blindside looks like in slow motion, not a shock event, but a structural unraveling that the top-line numbers keep obscuring until the damage is too deep to reverse quickly. Blindside tracks the threats that move before the market does. The full fast food threat roster, every tier, every dollar figure, every operator exposure, is in the series. Stay with us. The full fast food threat roster is live. Every tier, every figure, every convergence point. Follow Blindside for the complete series.